Simon Property Group is America's premier mall operator, claiming stakes in over 204 malls across the country. In spatial terms, this amounts to a staggering total of 241 million square meters in real estate assets alone. Thus, the Simon Property Group empire is truly a titan in the realms of retail, real estate, and commerce, emblematic of American capitalism at its most intense. Yet, as we speak today, in the many decades it has been in operation, Simon has never found itself deeper in crisis. With COVID-19's onslaught hitting American retail the hardest, Simon Property Group hasn't enjoyed an easy ride. At the height of the pandemic, its malls lay empty, desolate and lifeless. It hadn't seen such low occupancy rates for over a decade. Iconic brands, blooming fountains and swanky coffee shops had all been mercilessly emptied by nationwide lockdowns and quarantine measures. And what's worse is that the decline of malls was already well underway before the onset of COVID-19, with more and more people choosing to spend their dollars on Amazon Prime instead. Truly, the current retail climate hasn't been generous to malls, and in particular the companies that relied on them for their survival, like the once soaring Simon Property Group. See, mall operators don't actually sell anything. They only rent out space for whenever a store, like Gap for instance, sets up shop in a mall. The business model relies on customers hitting up those stores, buying a couple of jeans, and then sitting at a nearby coffee shop or restaurant for a post-shopping snack. But if the customers disappear and the stores lay barren, then the stores are forced to shut down and move somewhere else, presumably where customers can still be found. However, this hurts the company that lets the space for the store, as no shops means no rental income, and no rental income means no revenue and no viability of their business as a result. To make things a little dicier, a handful of store closures can quickly take a downward spiral, as most retailers rent their space based on a co-tenancy agreement. What this means is that if the mall's populated space falls below a certain threshold, then they will automatically close down. Why? Because the mall would simply be too empty for them if a handful of the biggest stores are no longer operating. In essence, the intensity of the challenge faced by the likes of Simon Property Group knows no bounds. But why the focus on Simon Property Group over all the other players? Is it because they're the biggest? Well, sort of, but not quite. The real reason as to why Simon Property Group is in the spotlight today is simply because they seem to have forged a rather novel and attention-grabbing strategy to deal with this shared predicament. Let's do a little thought experiment to illustrate the story a little further. Now, if you were a mall operator and had stores shutting down, leaving behind aisles of empty space, what would you do? Perhaps you could wait for another brand to move in, you could simply let it remain a barren and spooky corner, or you could buy out the collapsing stores themselves, keep them in your mall, keep them paying rent, and subsidizing your own store if it cannot keep up. Well, that's precisely what Simon Property Group is doing. If a store like Gap goes bankrupt across Simon's malls, it will attempt to buy out the company, keep its stores open in its malls, and hope that the quirky two-pronged affair lasts. Funnily enough, in search for a tenant, Simon Property Group ends up becoming its own tenant. What a masterstroke of ingenuity, one must concede. Or one must hope, better said. After all, it is a new and untested strategy, and nobody can tell if it shall truly deliver or not. What's more, part of the reason why Simon is doing this in the first place is largely down to its size. As it owns several malls across the country, it effectively hosts a large portion of the country's biggest brands. So, by saving one brand from liquidation, it could potentially save hundreds of its stores from closing down in its once bustling malls. If another group, let's call it Frank's Property Group for instance, only operated 2 or 3 malls, it would not be feasible for Frank's to buy out an entire company to merely save a couple of their tenant stores from closing down. As a result, Simon's size cannot be removed from the equation. In fact, one of its smaller rivals, Brookfield Property Group, was facing a similar situation of COVID-induced closures among its tenants. Hosting many of the same stores as its larger rival, e.g. JCPenney, many of the bailouts that Simon Property Group has embarked on have been done in partnership with Brookfield Property Group. Anyhow, let's take a look at which businesses Simon has injected this medicine to up till now. Most recently, Simon & Brookfield salvaged departmental store chain JCPenney from collapse in a jointly agreed $800 million deal. In August 2020, they sealed the deal to bail out Brooks Brothers for $325 million in partnership with Authentic Brands. The joint venture between Simon Property Group and Authentic Brands is known as SPARC Group, short for Simon Properties Authentic Retail Concepts. Notably, Brooks Brothers owed over $10 million of rental arrears to Simon Property Group alone. In the same week as the Brooks Brothers purchase, Spark also acquired Lucky Brand for $140.1 million. In February 2020, fast fashion chain Forever 21 fell under Simon's protective umbrella, acquired in partnership with Authentic Brands and its rival Brookfield Brothers. In total, Simon is expected to own or part-own in excess of 400 stores within its own properties. Currently, it is also in talks with Amazon, mulling the option of opening a cluster of fulfillment centers in the empty corners of its malls. This doesn't mean the many more retailers facing considerable financial distress but still awaiting some degree of replenishment. Numerous mall kings like Neiman Marcus and J.Crew have filed for Chapter 11 protection under US bankruptcy law to help them ride the wave of insolvencies. Whilst Simon Property Group could potentially acquire another cluster of chain stores, it would be naive to expect a single mall operator to rescue the entire retail sector from its impending apocalypse. Nevertheless, in taking this route, CEO David Simon remains optimistic. In his own words, there's just nothing out there that says you can't make smart investments outside of your core businesses. And he has a point, truth be told. Analysts at Center Square Investment Management have labeled it as the least bad option right now, saying that alternatives are way worse. Looking at the numbers, Simon's earnings have taken a noticeable hit throughout the pandemic. In April and May 2020, they were missing about 49% of their rental income from their combined population of tenants. Whilst this number picked up slowly in the following months, mall occupancy still remains markedly below pre-2020 levels. Retailers like Gap are being sued for withholding overdue rental of over $60 million, whilst other retailers like Abercrombie are suing Simon for overcharging rental payments during the months of lockdown in 2020. Simon Property Group is finding itself increasingly entangled in a spiderweb of rental disputes, lawsuits, and legal complications at a scale never before seen. Against such stiff allegations, it makes a lot more sense to buy up the retailers, keep the rental income flowing, and the business afloat for as long as the storm continues. And the silver lining in this saga is that Simon Property Group has a rich pool of liquidity to float on, having around $8 billion in cash reserves. The mall operator is in a relatively strong position to dole out its cash as an emergency stimulus if it keeps their business alive. That said, critics are plenty, and not everyone is on board. Advisors at Green Street Consulting are amongst the few to have raised an eyebrow. Head advisor on retail, Vince T-Bone, has pointed out that competition could take a blow as Simon Property Group only holds an incentive to bail out large retailers, making it more likely that small retailers with a smaller mall presence would fall across the cliff edge without a savior. Furthermore, embarking on a business that lies outside of one's core business area, like the shift from property to retail, means Simon is sailing on uncharted waters. Others have suggested that if the newly acquired retail brands were already faltering under their current management, then they are only going to continue faltering under Simon's inexperienced hands. Critics have raised various questions, so let's outlay the criticism and worries in three main sections for the sake of simplicity. Firstly, the most manifestly, the acquisition of stores themselves does little to solve the real issue, which is the decline in mall occupancy by the consumers. If Simon Property Group wishes to succeed in reviving its contracting rents, it will not be sufficient to simply rescue its tenants and hope everything else falls into place. Instead, it will have to supplement this strategy by successfully attracting the customers on their shop floors again, or else they'll only be delaying the inevitable. Secondly, stores going bankrupt often suffer from a flurry of issues in their management and operations that cannot be solved by a mere bailout from a Good Samaritan. JCPenney, for example, has been floating on a massive pile of unpaid debts. Throwing money at a failing business cannot repair the faults and inefficiencies that led to its demise in the first place. Thirdly, is that as creative as the buy your own tenant stratagem sounds, it screams as woefully uncreative when you dig deeper. In other words, it can be best described as an emergency lifeboat that'll prevent you from drowning, but not send you sailing the waves in glory again. As mentioned above, propping up empty stores will do little to nudge the customers back onto the shop floors. Something a little more deserving of the creative tag, perhaps, could involve opening gyms, leisure centers, health clubs, yoga centers, theaters, virtual reality gaming clubs, or anything else that's more likely to tickle a consumer's fancy in these challenging times. To sum up, however, we can agree that in the short term, Simon Property Group is on the right track. The long-term picture, however, is tainted with multiple unknowns and uncertainties. It is difficult to tell where the future is headed for mall operators as a whole. Funnily enough, David Simon labels critics as probably the same people that told Amazon to stay in the book business. Whether buying your own tenant can be equated to Amazon's explosive expansion into online retail, we can agree on the fact that not everyone's up in applause at the long-term implications of this move. In spite of that, Mr. Simon concedes, at the end of the day, if we screw up, we will have lost a de minimis amount of money. And credit where it's due, buying your own tenants is a well-formulated strategy for the immediate future that will buy Simon Property Group some valuable time to forge a pathway into a changed future. Hoping that the additional dose of time delivers this promise of revival, CEO David concludes by urging skeptics to give us time to prove our thesis right. To David, in a spirit of cautious optimism, we say, granted. Let's hope time sees your picturesque malls burst with life once again. So, what do you think about the commercial real estate industry's new strategy? And when was the last time you visited a mall? Share your thoughts in the comments section below. Thank you all for watching. I'll see you soon. Continue to share great business stories, past and present, and whatever else happens in the business world. So thank you all, and have an excellent rest of your day.